Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, April 17th at about 3:15 Eastern. Well, Wall Street bounced today as Boeing said it would resume production of commercial jets. Investors also betted on President Trump's plan to reopen the economy and hopes of a potential drug by Gilead Sciences to treat COVID-19. Boeing shares soared 11.9% on plans to restart commercial aircraft production in Washington state after halting operations last month due to the coronavirus pandemic. And on that note, let's go on to three charts that could give us some insight into the week to come. First of all, as we usually do, we're going to look at a daily chart of the S&P 500 spider, symbol SPY. As you all know, this is the tracking stock that closely follows our S&P 500 index. Now, when I captured this chart today, the SPY was trading at $283.95. We all know that it made its all-time closing high on February 19th at $338.34. So if we go from up there at its all-time highs to down where we are today, the SPY is 16% off its highs, which is certainly a welcome relief from where it was down on March 23rd at about 218. So the SPY is now 16% off of its highs. So we're out of bear market territory. We're into correction territory. As you can see from that 218 low, the SPY has clawed its way back into correction territory and is currently 30% above its March 23rd low, again at 218 or 2180 on the S&P 500. Now this week it is kind of traded in a sideways motion here, positive to be sure. Clawed its way over the 20-day moving average up to this 50-day moving average, which is the green line coming down overhead. Now, the green line whacked the SPY on its head today, and of course the S&P 500 too. So the green line, the 50-day moving average, is moving lower, coming in right now at $285.76, or about 28.57 on the S&P 500 itself. Now, nearby support here, very nearby support, sits here at about 275, 276. That would be about 2750 on the S&P 500 index. Then we have more support down here, potential support at about 267, 266, and then more down here at about 244 or 2440 on the S&P 500 itself. In this move, this move up, and certainly this week, keeping the market higher was technology stocks, certainly healthcare stocks as well. This is a fantastic move up considering the U.S. economy is pretty much shut down. A lot of it is anyway. And we know a lot of FOMO went on during this rally, a lot of fear of missing out. Again, certainly tech stocks and healthcare stocks helped out a lot. Now, what I believe might be happening here is I think the market's getting, as they like to say, a little too far over its skis. I'm a skier. If you are one, you know that when you lean over your skis and you're headed downhill, that makes you go a whole lot faster than you would if you were to pull back, stand up a little straighter. So in this case, though, what they're saying is the SPY, and what I think too, and I want to be wrong, but I think the SPY has gone up too far too fast in this case. Certainly we all want to return to the economy we had, and even better, but at this moment, with everything we have going on and probably facing a recession, this run-up may have been a little overzealous. So because of that, and because we're going into first quarter earnings, that they, as you know, we're already into them, we're going to be looking from guidance from the blue chip stocks, the momentum stocks, particularly to see how energy is going to do. Financials came in kind of ho-hum this week. So if you've already started bottom fishing, and I said this last week, but it certainly remains true, especially now. If you've already started bottom fishing, if you're already in some plays, please be careful, and please put in your stops. We could have a retracement here, certainly back down to 265, something like that. Maybe even a little lower, and maybe this takes another 2 weeks to happen. I don't know. It just it's starting to feel like we're getting a little too far ahead here. So please do remain watchful. Please do remain with your protective stops in. Now we're looking at our next chart here, the Invesco QQQ. As you all know, the QQQ represents the NASDAQ 100, very important index in the stock market and home to some of the biggest momentum players. The FANG stocks is what we typically call them, Facebook, Amazon, Apple, and so forth. Now they definitely, Amazon leading and Netflix not far behind, made a huge run up this week, and it was great, and it was tons of fun, and it brought the market even higher this week. Today, however, you will notice when I captured this chart, the QQQ was trading at $213.36 after going up to about $216. It gapped open this morning, and that's a good thing. I mean, gapping open is a good thing, but that gap got filled very, very quickly. The short sellers came in and pounded this thing lower. So look at the angle the QQQ is rising in. Now you say, well, Toni, heck, it's called a V-shaped recovery, and I totally get that. I just want to make sure that these prices moving so much higher, these PE ratios moving so much higher, considering what we still have left to face, I would like to, I'm wondering if they can, if this big move up here can remain as tough as it is. Now, the all-time high, as we know, for the QQQ was on February 19th at $236.96. Pretty much we can call it 237 up here. So now the QQQ is only 10% off that high, so it's just barely in correction territory. When price gets into correction territory, that means it is 10% lower than its all-time high, and that's where we are right now for the QQQs. As you can see, it's moved up nicely over the red line. It's 20-day moving average. Last week when we talked, it was just over the 200-day moving average, the black line. Right now, as you can see, again, it's nicely over the 50-day moving average. It does have resistance up here at 215. 219 would be probably a little closer. So 218, 219, right in there is resistance. Again, the price came up today, gapped open almost to that resistance point and fell down. So we have nearby support here at 205 at this gap. We have more support down here at, let's see, that would be about 203. More down here at 195. Right here is support. So we see resistance here. We see that price has moved up over the 50-day moving average. And up into this resistance point here. We know that Q's gap down today. As I said, Amazon and Netflix have just risen just like crazy and really getting way ahead of their skis, as we like to say. You can also look down here and see the RSI is getting very near to overbought territory. So this is good news. The question is, can it last? And that's what we want to know as we move into first quarter earnings season. So I would be very careful here. Of course, I usually am, but I would be very careful here, especially if you've invested in any momentum stocks, technology stocks. Semiconductors are up quite a bit. Just to maybe put in your stops here. Certainly nobody wants to ride this beautiful wave up and then ride another wave down. Not knowing if this will happen, hoping I'm wrong, but I think this is a good time to make sure that your stops are firmly in place. And now we'll go on to our final chart for the day. This is a daily chart of the iShares U.S. Real Estate ETF, the IYR. The IYR has 113 holdings. Top holdings are American Tower, Crown Castle, Prologis, Equinix, and Digital Realty Trust. Of course, these are all REITs, real estate investment trusts, in this. Now, with this IYR, I'm getting more cautious again. Last week, we were in the AIQ, which was more toward artificial intelligence and technology. Some of those stocks we talked about a few minutes ago were in that ETF. Excuse me. Now, I'm getting more conservative again, looking at the IYR. Now, the all-time high here for the IYR was up here in February at $101.75. When I captured this chart today, the IYR was trading at $75.53. That's down 25% from its all-time highs, but it has rallied 34% from its March lows. So it's come up dramatically, although not as dramatically as some of the tech sectors and industry groups. I kind of wanted to get something here that's more conservative going into the next couple of weeks. And I think the IYR may be a place to look into. So the recent high up here was $80.12. We see that. So that is our next point of resistance. And again, the IYR is now at $75.53. So we have a nice, typically a nice swing trade set up here, or maybe a trade to get in for a little longer at $75.53. I'm going to watch the IYR into the coming week. I'd like it to pull back a little more, but if it doesn't, it's okay. If it can remain above $71, which would be right about this support, or now support point, was resistance point right here. If it can remain above $71, I may buy a very small position of the IYR with an initial stop down here at $69.50. As I've said before, if the market rolls hard to the downside, I may exit this trade before it reaches my stop. Now, on the positive side, if in the next, maybe it'll take a few weeks, if the IYR, maybe not, I don't know, if it can come up and move up and above and move over the 50-day moving average, and that will be at 181 or 82 by the time these two meet up, I may add more shares to my position. But again, I'm going to start with a very small position, stop at $69.50, and then just simply see what happens. Of course, if IYR starts moving up and moves up and over the 50-day, then I will turn my stop into a trailing stop. So you may want to keep an eye on the IYR in the coming week. If you want to see a calendar of the economic reports, go to toniturner.com, click on Education, and then on Economic Reports. This week, during all the turbulence we've had in the last few weeks, I've started doing topics called the Question of the Week. And I think they've been doing well with all of you out there. You can always let me know at info@toniturner.com. The question of the week this week is, do my personal patterns synchronize with the market's patterns? Do my personal patterns synchronize with the market's patterns? Now, as we approach the financial markets on any given day, you and I, we both do it, overlay our personal patterns on top of the market's patterns. The result of the combination of these two dictates our trading success. So if you get to the market and you think, oh, the market should go higher today, right? The market should go higher today, like today. Gilead Sciences came out last night with the announcement that it had a potential successful treatment for COVID-19. And so today, of course, the market, even though it was tired, it started a lot higher. It started coming down soon thereafter, and although it's positive, it's not as positive as it was, and both the SPY and the QQQ did gap up and then started down. So If you said the market's going to go tons higher from here and you started buying, some of your stocks might have fallen lower, and then you've got quick losses on your hands, and you've got to deal with that. So another thing to think about, if you come to the market and you don't feel well, if you're tired or you're upset about something, that is not a time to put on new positions. Believe me, it's not a good idea because you're looking at the market through kind of tinted glasses. Maybe they're tinted a little gray. So if our pattern and the actions we take agrees with market direction and our target stock, then we do well. But if our patterns don't sync up with the market, then we may experience losses. And again, that definitely goes back to just flat not feeling well or feeling negative for whatever reason when you approach the market. Our goal is to come to the market with a mental and emotional foundation, or we can call it a pattern, of calm confidence. Calm confidence. Calm within yourself and confident that you can see the market's overall pattern and confident that you have the discipline within yourself to execute the necessary risk management for each trade. That's where the confidence comes in. You're not confident that the market will go higher. None of us know whether it will or won't. But you do have to have confidence in yourself that you will execute the necessary risk management for every trade. So before you enter the next trade you make, ask yourself, today, do my personal patterns synchronize with the market's patterns? And if they do, and that works out, you are on the path to more profitable trades. Now, just as a reminder, we are offering my online training, how to bottom fish like a pro, at a 20% discount. We've done that for the last few weeks. This may be a good time to learn how to bottom fish effectively. So to check it out, please click on the button below or go to the link on this screen. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.